Wait, we're live, Josh, and I don't know how to do this overlay. What's our intro overlay?
Holy! So,
Three, two, one.
Boom.
You're fired.
There we go. I know. This is crazy, ladies and gentlemen. My name is Judah Hoover, and this guy right over here is Josh Weidman. This is the Build and Grow with Real Estate show number 133. Can you believe that we've been doing this this long? And Josh, you're on the road today. You're going up to the Poconos to do a deal, or
I'm actually. I'm two things. I'm funding a loan in the Poconos probably tomorrow. This is
Gotcha.
We got the application yesterday. It has to close yesterday. So, I'm going to look at it. We put eyes on, one of the reasons that we only lend around our local offices is that we inspect every property. I want to know what we're investing in, right? So, when I say we can close in 24 hours, that's what we mean. So I'm up here, I'm taking a look at a property, and we're going to be funding this tomorrow. So long story short, hey, sometimes you got to do what you got to do. We got to broadcast on location.
You got to do what you got to do. So how long of a drive is it one way for you?
It's about 2 hours. But you know what? I love audiobooks.
Right.
So,
what are you reading right now?
I'm 10 minutes outside of Scranton. I actually pulled off.
What are you reading right now?
What am I reading or what? So I just finished a book by Chuck Palahniuk that is amazing, and it's called
Choke?
Oh, no. It's his newest novel. He didn't write anything for like 4 or 5 years, and then it's called something day. It's like anyway. Long story short.
This is awful radio. Great.
I know.
He's the guy who wrote Fight Club. I read Fight Club, and I read like half a Choke, and
which is hard.
I just lost interest in Choke. So anyway,
some of his stuff, but more importantly, what I'm listening to and what I continue to listen to is Never Split the Difference. I love that book. This is like my 5th time through it. If you haven't read it, read it. Pick up
I need to listen to it on Audible. My sister Jana, who who's you guys are each other's biggest fans. She talked about that just the other just the other day. So all right, so we're going to get started here with some stuff. First of all, thanks everybody for checking us out, and please don't forget to like and share the show. Appreciate Jana and Steve and Taz and others who have already liked and shared, and Josh, and appreciate you guys coming on, and we really like our regular and loyal listeners. We've got some really great guests lined up for the rest of the week, and we hear a lot of questions about how do I do real estate deals, and how do I do traditional financing. And so one of the things that we like this show to be is a safe place to be able to answer questions. And one of the things that we're going to be doing is answering some of these difficult questions. Now, I only have one screen. I don't have 2 screens like Josh. So this is going to be a little bit different for me, and I have to use my phone here as a monitor. So,
and Judah, I wanted to kind of piggyback on this. So we try to keep this show relevant, and a lot of times we kind of skim over things that Judah and I have done, dozens or hundreds of times.
Hundreds of times,
right. Right. So yesterday, I was talking to one of our viewers, and we were talking about like, hey, I'm thinking about buying a house. It's going to be my primary residence. How does that process go? What are some of the things that I need to know about? And it really jogged something in my mind. It made me look back at the properties that I've bought for my primary residence. And this is really funny, but I've owned a lot of houses. I've never gone through the conventional mortgage process. And so when I was talking to Judah about this, he's like, yeah, we ought to do a show about this. So bottom line is that's where this came from. if you have things that you are interested in talking about or want information on, if I don't know it, Judah does, and vice versa. So, there's a lot of information that we've got wrapped inside these little brains of ours that, if you've got a question or something you want a topic you think would be relevant, bring it up. Send us a text, send us a phone call. Phone numbers are right at the top of the screen here. So anyway.
Yeah, we try to have these shows be relevant to the largest majority of people. Not every show is going to be for every person, but this is a lot of times I've always been surprised how many even experienced mortgage brokers and experienced mortgage lenders have no business trying to explain the mortgage process to people because they just don't get it. So we are going to be talking about the steps, the stumbling blocks of financing your next real estate purchase, basically understanding the mortgage process. One of the things that we want to start off with right away is people misuse these terms, pre-qualification and pre-approval. These are two different things. A pre-qualification means, are you qualified? Well, even before we figure out if you're qualified, it's a qualification. It's not an approval. So you're qualified to buy a loan, which just means a loan officer is looking at your situation, and in theory, you tell them you make $100,000. You tell them that your credit score is about 650, or maybe they pool your credit so they know that, but they don't really have your income put together and stuff like that. They haven't actually seen pay stubs. A pre-approval is a loan application. A pre-approval is you actually have a hard pull of your credit. The loan officer has verified their income. Not the loan officer's boss, not the loan officer's, not the underwriter or anything like that, but at least the loan officer has looked at that and is ready to issue a pre-approval. So it's a full application minus the property. So a pre-approval, I don't know if I'm going to buy 123 Main Street or 123 Apple Street, but please give me a pre-approval letter, Mr. Lender, so that I can go shopping.
Well, and a good way to think of this is the pre-qualification is kind of like if everybody in the world was 100% honest with everything they said and transparent, and frankly, if they understood everything that went into borrowing, a pre-qual and a pre-approval, they'd be the same thing. But what often happens is, Judah says, hey, look, I made $120,000 last year. In actuality, it's $116,500. And, he says, oh, I got a 650 credit score or a 700 credit score. In actuality, it's 780 or 687, and it seems like a small difference, but it's going to make a big difference when it comes to the loan that you can afford, the loan that you can actually get approved for and get funded for. And so,
100%. And so what happens at this point is you're going to be able to go shopping for a house, and getting a strong pre-approval letter, not from somebody on the internet, from a local lender that people can call, is very important, because if I list Josh's house, let's say I'm Josh's realtor, and I list Josh's house for sale. That house is out there marketed to everybody who has access to the MLS.
Yep.
Well, once we accept an offer on that house, it's now taken off the market. So new people aren't going to be looking at it. New people aren't going to be making offers. New people aren't going to be doing things. So if you come to me, dear listener, and you say, I want to buy Josh's house, I'm going to say, well, I'm going to take Josh's house off the market for 30 or 45 days. Prove to me that you're worthy of that. And how you prove that you're worthy of that is by giving me a pre-approval letter from a lender that knows what they're doing. You do not need a mortgage commitment. You do not need to clear the close, but we're just taking it off the market at this point, and you are pre-approved to make that happen.
Well, and in an environment like we're in right now, where there's so much competition on housing, the stronger that commitment is, the more the stronger that approval is. If everybody and their brother knows that, when he gives you a pre-approval letter, you're all but ready to close. You need an appraisal and a couple documents. Well, that offer is going to be a heck of a lot stronger than if you go online to one of those, free prequal letter sites where they ask you 5 bits of information, and then and then try to get a lead for somebody to write the loan. So anyway, go ahead. Sorry, Gina.
No, yeah, you're exactly right. You want it to be a trusted, reputable lender that you're working with. And when I had my mortgage company, I worked very hard to keep my reputation to a position where people knew if they were getting a mortgage pre-approval letter from Judah Hoover, it meant something and it was worthwhile. So
Yep.
You're looking at this point, you're going to make an offer on the house. That offer, the listing will say, we're willing to accept FHA financing or we're not. We're willing to accept VA financing or we're not. We're willing to accept all these types of financing. Sometimes it's just cash and conventional that they're willing to accept. So the pre-approval letter will say what type of mortgage you're pre-approved for. And the listing agent will decide to accept the offer or not based on a variety of factors. How strong that pre-approval letter is one of the things. Once you then work with your agent and you get a signed contract between buyer and seller. And once you get that signed contract between buyer and seller, the house comes off the market. It actually is just listed as pending sale. No one knows what purchase price it was agreed to or anything like that, or when the settlement date is going to be, but it's just listed as pending. And what you're going to do then is work with your loan officer and prepare the entire loan package. So you are going to, put together all the pages of your tax returns, all pages of your bank statements. They're going to give you a list of 10 or 15 different things that you need to put together. And what's important is when you put these things together for your loan package, you need to understand that the underwriter wants to see all pages of the bank statements. So this wasn't a problem, and then it did become a problem, and now it's not a problem so much anymore. The bank needs to see, if it says page 1 of 4 at the bottom, they need to see page 2 of 4, page 3 of 4, and page 4 of 4. And sometimes what people would do is they'll only scan in the fronts because the backs are like the canceled checks or the backs of the pages are blank or something like that. It is not a complete document if they don't have all 4 of those pages. So if you submit it without them, you're going to get stipped for them. And we'll talk about the stip process later, and they're going to come back. The other thing that you need to know right up front is that it's a very good idea to order any of the inspections that you're going to be getting. So you may or may not be getting a radon inspection. You may or may not be getting a termite inspection. You may or may not be getting a water test or a home inspection. You're probably going to be getting an appraisal. You're probably going to be getting title, and you want to order all of these things right away. Your agent can help you with who you should order them with, but they're technically supposed to give you at least 3 names. Otherwise, they're steering. Now, we're not going to get into a big, long, drawn-out conversation about that, but ultimately it's your choice to decide who you're using and for you to go ahead and get that ordered. So you do that right away. You also want to tell your loan officer about any dirty little secrets in your history, because they might come up during the loan process. So if you have a private loan to an uncle and you're paying him $250 a month because he lent you $10,000 5 years ago, you want to let your loan officer know that and say, hey, you're probably going to see checks coming out of my bank account. We don't have any loan docs drawn up. It's just a private loan. I just pay him back. If you have back due child support that's coming out of your check, or you didn't file taxes for a year or 2 and there's back due income tax that you're paying there, and it's going to show up as being a deduction from your pay stub. You want to tell your loan officer about that right up front so that they can tell you what other and extra documentation they need. It might be simple, it might be easy, it might be easily explainable, but you've got to actually write a short letter of explanation, called an LOX, about it, sign it, date it, put it in the file. Let the loan officer write it, they'll send it to you, sign it, and put it in the file. Also, a lot of people who were investing back in the 2008 to 2013 timeframe went through bankruptcy, and sometimes those bankruptcies led to divorce. So a lot of people are facing bankruptcy or have been through bankruptcy, and was what I mean to say. You want to get your discharge letter and your list of debtors for the bankruptcy. So your discharge letter. Go ahead.
No, go ahead. Finish up with bankruptcy. I'm sorry. I thought you were moving on. Before you move on, I want to talk about the package real quick. But go ahead.
So you want to get your your discharge letter and your list of debtors for bankruptcy. For a divorce decree, you're going to want the marriage settlement agreement and the divorce decree. The decree is like the opposite of, the pastor says, or priest or local official says, I now pronounce you man and wife. The divorce decree is the court saying, I now pronounce you divorced. And you probably got that document and, shoved it aside someplace and didn't really think about it. And it could be 5 or 10 years later, but you're going to need that document for your loan, and it's important to have it. And so you may need to call that attorney or dig it out. And I've worked on countless loans for people where a week before settlement, they're trying to find their discharge letter or they're trying to find their divorce decree, and you absolutely need that stuff, and it needs to be in the file.
So one thing about putting this title package together, this is going to be, this is the most painstaking part of the loan process, right? And it's one of the things that if you're thinking about buying a home 90 days from now or 6 months from now, it's a great idea to sit down with a loan officer. And, right now they might be too busy. I get it. But schedule an appointment, put together your tax returns, put together your, W-2s, canceled pay stubs, all the bank account statements, all that kind of stuff, and go in and lay out the case and, lay it out for them. If there's any skeletons in the closet, discuss it then, because it's a whole lot easier to fix 3 or 6 months of bank statements in the future than it is to do 3 or 6 months of bank statements in the past, right?
Yeah. So this is a great thing, Josh, because this coming July, I'm going to be buying a house for myself personally. Maybe, February, March time, something like that. But somewhere between March and July, I am going to be purchasing a primary residence. I have done countless real estate transactions in the past 2 to 3 years, and I will probably do real estate transactions between now and then, but all that stuff is investment. Because I'm looking to do something in my own personal name for my own personal primary residence, I've already begun talking with my banker about what that looks like. And my situation is obviously pretty complicated with different investments and different sources of income and streams of income and things like that, and just making sure that all that is properly documented and put together. So yeah, you really can't begin this process too soon. You really can't begin this too early. And if you set yourself up for success, you'll have a whole lot easier go of it. So let's talk about what happens then. So once you get this whole thing together, at some point in there, as you're putting your package together, the loan officer is going to run the system through what's called an automated underwriting system. So either DU or LP are the two big ones that are out there. And it basically tells the underwriter who works for the lender, will Fannie Mae or will Freddie Mac buy this loan? Which is what the underwriters want to have happen, because they want to sell the loan on the back end. They want to sell the loan out the back door before the ink is even dry. They're going to have sold that loan. They might retain the servicing rights to it. So you might still make your payments to Fulton Bank, for example, but Fulton Bank sells all their mortgages out the back door before it's even dry. And how they know they can do that is because they ran it through an automated underwriting system. But it still needs to go through actual underwriting. So what we do is we package up the loan, send it into the underwriter. And the underwriting turn time can be different. And when that loan goes into underwriting, it's always a good idea to ask the loan officer, what's your turn time on underwriting right now? Because maybe it's 2 days, maybe it's 2 weeks. And remember, your loan is probably being submitted to underwriting about a week to 2 weeks after your property went under contract, because it takes you some time to put all that paperwork together. It takes your loan officer some time to do some of the work on their end. So if your underwriting is at 2 weeks and you took 2 weeks to put your loan package together and get all that stuff to the loan officer because you're like, oh, we got 30 days to close, so I can get this stuff to them a couple days before closing, or I can get this stuff to them 15 days before closing, and I'm really doing great. Well, no, because it's still got to go through underwriting. Your loan officer and maybe talked with the underwriter and maybe has a pre-approval, but he doesn't actually have a approval for your loan. That's what comes from the underwriter. Now, here's the deal. If underwriting is a week, calling that loan officer every day and saying, is my loan out of underwriting yet? Is my loan out of underwriting yet? Just is not something that is valuable, helpful, or actually moves your loan forward. Yelling at your loan officer doesn't actually do you any good. I really like a lot of NASA movies. And whenever you watch these NASA movies, they're waiting for the space shuttle to come in, or they're waiting for the capsule to come in, depending on what era NASA movie we're talking about. And they say, while the space shuttle comes through the ionosphere or whatever layer of atmosphere it's coming through, where they can't have radio contact with the shuttle. Maybe somebody can tell me in the comments what causes that exactly. But there's like a 3 to 5 minute period of time where we have no contact with the shuttle. And everybody in mission control is looking at one another, and they're all wondering, is it going to come out? Isn't it going to come out? But there's nothing they can do at that point while it's in this black hole to make anything, to make it come out sooner. They just have to sit and wait. And that's what underwriting is like. You just have to sit and wait. It's a communications black hole. You don't pepper underwriters with questions, because when an underwriter is working on a file, you want them to be able to work on that file. You don't want them to be interrupted with questions on another loan about when are you going to get to my other loan, because that takes away from them. Just like when they're working on your loan, you don't want them being interrupted when they're working on your loan, so don't interrupt them while they're working on somebody else's loan.
And by the way,
yeah,
this is a very good way, if you're a loan officer, to be able to add value to your client. Right. I was watching Steve DeVos from Never Split the Difference. I was watching an interview specifically about real estate agents. And there's this woman in California. She has the highest referral rate of any agent in the entire country, right? And the reason that her referrals are so high is because before she gets off the phone with anyone, she lets them know, I'm going to be calling you back next Wednesday at 2 p.m. and it goes into a calendar. And her team, they reach out on that specific day and time. And sometimes it's just to say, hey, look, there's nothing new. And it's the same type of situation with the loan. If you know that you have a borrower going into underwriting, and you know it could be 2 days to 2 weeks, we say, look, here's what we can expect. 2 days from now, I'm going to call you. And I'm probably going to say I don't have anything for you. But I'm going to call you in 2 days. Well, guess what? They're not going to call you. And when you give them a ring, they're going to be thrilled that you touch base with them.
Right.
Anyway.
Yeah, that's true. So I've got a couple of those phone calls that I actually need to make today on listings that I have, and just say, hey, by the way, here's an update. Not much has changed, but this is just your regular update on what's going on. We've ordered this, and we're doing this, and we're doing that. We're still under contract. We're still moving forward. Nothing has changed, but no news is good news. And it's good to just update people and tell them that. So after the loan comes out of underwriting, 15 years in the mortgage industry, hundreds and hundreds and hundreds of loans. I've never seen an underwriter say, yep, I'm ready to close this loan. I don't need any more information. Now, underwriters would say that it's because of, sloppy packages the loan officers put together, but that's the old fight between loan officers and underwriters. So when they come back, they're going to list steps or stipulations. So what they're saying is, we at ABC Mortgage are committing ourselves. It's a mortgage commitment. We're committing ourselves to lend $200,000 to Josh Weidman to buy ABC property, as long as I review the appraisal and it looks good, as long as he gets me the March pay stub. He gave me the April and he gave me the May, but I need 3 months. So I need to see that March pay stub, or whatever the case may be. Maybe they only need to see 2 weeks of pay stubs, but they're always going to be asking for something different. And those are called stipulations, or in the industry, we just call them STIPs. Your loan officer will work with you then and package that up and resubmit to underwriting. And there's a separate turn time for that. Clearing STIPs is, usually half the time as an initial underwrite.
Well, hey, real quick before we get to the clear to close, last thing with underwriting. I think this is an important part of the puzzle that we didn't cover here. What's the whole purpose of underwriting, Judah?
To find out whether the borrower is lying and to find out whether there's fraud going on.
Well, but beyond that, it's probably also to see if they have the ability and willingness to pay. Right? Like, they want to make sure that the person that they're giving this money to has a very high likelihood of paying it back. And if there's fraud or there's, whatever, that's kind of an outlier. But
I always say there's two things you're trying to prove. You're trying to prove I have the ability to pay this loan back. I'm not lying to you.
Right.
And it's funny, in the mortgage world, I got really good at understanding and seeing crime and understanding how the criminal mind works, because there's just 1,000 things that criminals can do, and they have to suspect everybody. Otherwise, people would take advantage of it. You know what I mean? Though, if you're doing a $200,000 mortgage, right? And let's say the bank, because of their fees and stuff like that, let's say that they make $2,000 on that, right? So the bank profit for doing that $200,000 mortgage is a $2,000 fee. That's what the bank is going to profit.
Right.
Well, if somebody commits mortgage fraud to the tune of $200,000, that bank has to do 100 mortgages without fraud just to make up for that one case of fraud.
Yep.
It eats up so much of their profit if only a little bit happens here or there, and it just really, really causes a whole bunch of problems. So the banks think, and it's the underwriter's job to assume no one can repay until you prove to me otherwise. Everyone's committing fraud until you prove to me otherwise.
And with that context, it's really amazing that people actually get mortgages, because right. I mean, and that so many people do, because there are so many reasons and so many whys of situations that come up. Everybody's financial situation is really, really unique, and without digging in and asking questions. So STIPs, they're normal additional questions to get clarification.
Right. So you need to get to this mortgage commitment usually about a week to 2 weeks out. But mortgage commitment is not a clear to close. A clear to close is the underwriting saying, I've signed off on all these STIPs. You can close this loan when it's convenient. And it then goes over to the closing department. That's a whole other thing and everything like that. But realtors who don't know any better, sometimes they see a mortgage commitment and there are STIPs still on there, and they're like, oh, well, there's still STIPs on there. This isn't actually truly a mortgage commitment. And they're like, no, it's still a mortgage commitment. It's just not a clear to close. And there's a reason why the contract calls for a mortgage commitment date, but not a clear to close date. So this is once everything has been signed off on and taken care of, and you're good to go. So I mean, our hope with doing this was that you just kind of understand, number one, the difference between pre-qual and pre-approval, understanding that the reason that's so important is because you're asking somebody to take their property off the market. The other thing that we wanted to explain is what the difference between putting your loan package together for the loan officer, and then the loan officer gets that together and puts it in front of the underwriter. And there's specifically reasons why the borrower and the underwriter never talk and are never supposed to talk, because the underwriter is supposed to be a mean, heartless, uncaring robot. And I've met many who have fit that bill quite well, because you don't want them to have any feeling or any sympathy for the borrower. And if they have no sympathy and no feeling for the borrower and the loan still gets done, it's a good loan, and it's good for the shareholders of the bank, and it's good for all the other people who are relying on that bank to close and do business with. And then we also wanted to talk about the difference between clear to close and mortgage commitment, and what steps are, and how you can have a loan approved but still have steps. And there's a lot of there's a lot of things that go into this.
Judah, I gotta say one thing here, and that is, it is obvious that you're coming from this from a lender's perspective.
Right. From a loan
Right?
officer's perspective.
Yeah, those stinking underwriters, those heartless jerks. You could call them a heartless jerk, or you could say they're an independent third party analyzing data.
Sure.
Either way.
Sure. If you've never met one and you've never dealt with them, you could. That is how you could. You could look at that. Yes.
Fair enough. Okay.
Actually, it's really funny because obviously I'm trying to be so bombastic about underwriters so that you know that I'm telling a joke to your listeners. They play a very vital and critical role in the loan process. The other thing that I would say is, I was a loan officer, and a good, honest, decent loan officer for about 4 or 5 years before I started lending some of my own money and became a hard money lender. And as soon as I started putting my own money on the street, and where I was risking, I started asking more questions, and started asking the second and the follow-up question, and started playing a Columbo role a little bit. Wait, I just have one more question. Or wait, I can't pretend I didn't just hear you say whatever. Tell me a little bit more about that. So it is amazing how, even though I never committed fraud and never did any loans that I couldn't sleep at night for, when you're lending your own money and when your job is on the line, because underwriters' jobs is on the line, they're who the bank hold responsible for delinquencies and fraud. It is interesting how you just see things differently. So listen, we're a little bit long today, but I wanted to wrap up by just telling you about a 5-day challenge that Josh and I are doing, flipping houses without cash, credit, or criminal behavior. We're going to start this on November 2nd. We've been talking about this a lot. We appreciate everybody who's been signing up. You want to go to the Build and Grow with Real Estate show. You want to go to buildandgrowwithrealestate.com. This is going to be a website and a show and an education company that's dedicated towards networking and helping everybody make money with real estate. Make money from a job, make money from a career, make money and wealth for retirement, make money and wealth for quitting whatever other your day job is and doing just real estate. So this is the Build and Grow with Real Estate show, and you want to go to buildandgrowwithrealestate.com to get registered for this 5-day Facebook challenge. We are going to be talking about how to get buyers swarming to your listings, how to find all the inventory that you need out there. There is a ton of sellers out there who are just looking for some creative options and are disheartened and need the right person to show up. Can I tell you something, Josh? Here's how I know there's always room for real estate. Whenever there is real estate investors, whenever there is a sheriff sale, it's because we as the real estate community failed. If a sheriff sale ever happens, it's because the right real estate agent didn't come along the right real estate investor didn't come along at the right time and explain it effectively to the sellers how they could get out of that situation.
Okay, I thought you were saying the real estate industry, more so like listing agents and mortgage brokers. But I think you're right. You're absolutely right.
Every time a sheriff sale happens, real estate investors failed. And there is not saturation in this market until there are 0 sheriff sales. As long as there's sheriff sales happening, there is room for real estate investors to do more, and there is room for more real estate investors to enter the market. And I would say this, and obviously, that's never going to happen. And you can buy at the sale, you can buy after the sale, you can do a bunch of those things too. But we as real estate investors should be trying to find people and work with people before it even gets to sheriff sale. And that's what we're going to be talking about, how to find motivated sellers and work with them. So without further ado, I am, as you can tell, Josh
Shoot,
has 3 screens. I only have one screen, so this was a little bit difficult. Appreciate all these great comments that we got, and we're definitely going to be circling back around and reaching out to people and touching base here. So we definitely appreciate the people who like the show and comment and everything like that. Josh, you have anything to say before we sign off?
Nothing. We'll be back here again tomorrow. If you like the show, don't forget to like and share. We'll be here at noon tomorrow with more great content. And until then, go make some money.
See you, everybody.
See you guys.